Welcome to this explainer. Okay, so we're going to jump right in and uncover the invisible force that actually powers the financial world, totally hidden away from all those noisy flashing headlines. If you've been paying any attention to the news lately, you know everyone is hyper-focused on the exact same stories. But today we're looking at an underlying mechanical engine with literally trillions of dollars that people are just completely missing. So, what actually runs global financial markets? You might think it's company earnings, or maybe relentless technological innovation, or even just raw investor confidence driving everything you see day in and day out. Well, the uncomfortable truth is that the entire system fundamentally runs on cheap money. It is the absolute lifeblood of global markets. Think about it. When capital is virtually free, the whole ecosystem just balloons. Investors start taking wilder risks, businesses borrow heavily to expand, asset prices inflate, and that financial gravity we normally rely on, it just sort of disappears. And while the crowd is totally distracted by flashy AI tech stocks, wild crypto rallies, and domestic inflation reports, the true source of all this cheap money has been sitting quietly thousands of miles away, in Japan. It's honestly a brilliant irony that the most boring, quiet policy in the world funds the loudest, most chaotic markets out there. For decades, Japan has provided some of the cheapest money on the planet, literally acting as the silent engine of the global economy. Section 1. The mechanics. Understanding the yen carry trade. Okay, let's see how the foundation of our global financial system actually gets really fascinating here. So, to fight off years of weak economic growth and incredibly low inflation, Japan did something kind of extraordinary. They kept their interest rates historically low for decades. We're talking near or sometimes even below 0%. Really think about what that actually means. The cost to borrow money in Japan was practically non-existent for an entire generation of traders. No way, right? But it's true. And this highly unique environment created what's known as the yen carry trade. It's this massive, globally connected strategy. In short, investors borrow this nearly free Japanese yen and then funnel it into other countries to buy assets that offer a much higher return on investment. It essentially became the ultimate global arbitrage. The recipe is remarkably simple, honestly. It's almost like a financial cheat code for Wall Street. First, you borrow yen for pennies on the dollar. Next, you convert that yen into US dollars. And finally, you just take those dollars and buy something that pays you significantly more, like foreign government bonds, real estate, or soaring tech stocks. Now, let's look at the math behind the magic here. Pocketing the difference between, say, a tiny 1% borrowing cost and a generous 5% return leaves you with a pure 4% profit. Now sure, that margin might look kinda small on a single loan, but when giant banks and hedge funds do this with literally trillions of dollars, it generates astronomical wealth and completely floods global markets with endless liquidity. Section 2. The rule change. Japan shifts course. So what happens to a global system built entirely on cheap money when that money isn't so cheap anymore? Well, we are witnessing a monumental shift right now. Japan is finally stepping away from those ultra-low rates. And because markets care deeply about direction, the transition from cheap money to rising borrowing costs is an absolute shock to the system. It isn't that Japan's rates are suddenly higher than everyone else's, but going from effectively zero to anything higher, that completely alters the profit calculations for investors worldwide. This creates a brutal domino effect. As borrowing yen gets more expensive, millions of investors suddenly have to rush to close their positions at the exact same time. They're forced to sell off their foreign assets, buy back Japanese yen, repay those massive original loans, and pull their capital back home. One investor doing this, that's just a regular Tuesday. Millions doing it all at once, that creates severe market turbulence. Section 3. The global chain reaction. The bond market foundation. This massive capital flight brings us to a space almost nobody really pays attention to, where the ripple effect turns into an absolute tidal wave. Think of the economy as a house, right? Government bonds are the foundation. They set the baseline for borrowing costs worldwide. If that foundation cracks because Japanese investors suddenly stop buying overseas debt and take their money home, every single structure built on top of it starts to wobble. As those Japanese buyers leave, demand for these safer bonds weakens. So, to attract new buyers, bond yields must rise. And when yields rise, the cost of borrowing skyrockets for absolutely everything. Mortgage rates jump, car loans get pricier, businesses suddenly can't afford expansion loans, and even governments face massive bills just to finance their own debt. Now, this shatters a massive misconception. A lot of people just assume that if the US central bank lowers short-term rates, borrowing costs will automatically fall for all of us. But in reality, even if the US cuts rates, long-term borrowing costs, like your 30-year mortgage, might not drop a single point if the global bond market is reeling from Japan's policy shift. Here's the really critical distinction we need to make. Short-term rates are controlled by central banks, and they impact things like your basic savings account. But long-term yields? Those are dictated by global demand, inflation expectations, and debt supply. They dictate the heavy stuff, like 30-year mortgages and government debt. So the global bond market, not a local central bank, is the true pricing system for the whole economy. Section 4. What this means for your wallet. Okay, let's bring this all the way home. How does a policy change thousands of miles away actually hit your bank account? Well, the end of cheap Japanese money means some very real fallout for us. Homes stay painfully expensive to finance. Businesses hold back on hiring or expanding their operations. Governments have way less money for schools and roads because they're bleeding cash just paying interest on their debt. And honestly, perhaps most importantly, the era of your investments going up simply because money was free, that might be completely over. So as this incredibly quiet but totally foundational shift continues to unfold, we really have to ask ourselves, are we ready for a world where money actually costs something again? It's a massive transition hidden in plain sight, proving that the most important stories aren't always the ones trending online. Sometimes they're the quiet, mechanical changes that reprice the entire globe. Thanks for joining me for this explainer, and always remember to look beyond the headlines to see what's really driving the machine.